Welcome to TheoTRADE. This is Don Kaufman. September 8th, 2023. 35 minutes left inside of the trading week on this Friday afternoon. S&Ps, for the most part, massively unchanged. Look, we're going to discuss a tremendous amount about what is forthcoming in this marketplace. But what's critical to understand right here, right now, tech is down, but far from out. Let's get into it here on this weekend's update. As I was saying moments ago, S&Ps for the most part massively unchanged, but there is kind of an interesting area around the S&Ps right now. Something, okay, I think is a bit surprising, and that's this. If you look at the SPX, the mother of all products, for those of you that do not necessarily speak geek, the SPX, obviously an options-only product, okay, the marketplace in the SPX was looking for approximately a $47 move throughout the course of this week, right? That's what we term the expected move, right? So the expected move is 47 bucks. And one of the surprising things is we're on a Friday. Volume looks what I would term light and fluffy, right? There's not a lot of action in the markets. That's why they're massively unchanged. But much to my surprise, we're slipping off of the lower edge of the expected move. And the reason I'm surprised by that is there is this tremendous, and again, the market's not over yet. Like, you know, we're slipping off the lower edge, but in the last 10 minutes, we could rally back up to it. But I'm really surprised to see hedging activity is actually pushing us off. And you got to understand, like expected move, it's not about like some fictitious beast sitting at the 618. Not poking fun at Fibonacci's. Actually, I am, but it's not a fictitious beast over here. There is so much, okay, in terms of capital. We're talking billions of dollars that rest at the edge of this expected move that you would anticipate that markets are actually going to pull back to it, especially when there's this close. So I am a bit surprised to see us kind of hedging off of it. I mean, so much so that I got to tell you, that kind of indicates if we don't rally back up to the edge of the expected move, or at least close to it by the close, something's up. Like market anticipates risk coming into this weekend, and that does not necessarily have to be reflected by VIX. So that's something you're going to hear a lot out of me lately is that VIX, okay, it's kind of a dead animal. And the reason the VIX is a dead animal, VIX is, it's the S&P 500 volatility index. How could you say that? That's exactly how I can say it. VIX cannot see anything less than 9 days to expiration. Okay, what that implies is all the short duration stuff, which is where all the volume is right now, everything these days, everything is moving to the shortest duration possible. But markets in VIX can only see 9 days, and further out. In fact, the VIX is a 30-day, okay, average implied volatility. It's a time-weighted, VIX style implied vols, 30 days. The average is 30 days. So with that being said, you might look at VIX and thinking, oh, no, the volatility is definitely down. Okay, I would counter that and say, hey, look, there's huge breaches. Everywhere you look on the screen, there's these huge breaches of expected move. And ironically, this week, it looks like we're going to continue to have breaches of expected move. And again, much to my surprise. Now, let's get right down to business with talking about how I said tech is down, but it's far from out. There's, again, a couple of surprising factors. And this is a shortened holiday week of trade, right? We just had Monday, markets were closed. But one of the things I wanted to start with is kind of a quick review, if you will, of course, of a few sectors. I'm going to start with the financials, and I'm going to apply auto expected moves. The reason I apply auto expected moves, again, for those of you that have no idea what expected move is, it's how the option marketplace is handicapping forward risk. So like in the SPX, expected move is $47. That's not just a number, okay? It has to do with literally billions being traded, okay, in that market. It's like the average of what's traded in the marketplace says, okay, we're supposed to move higher or lower by $47. But the cool thing to look at expected move really breaks down the week beautifully. Like look here in the XLF. In the XLF, yeah, we started the week, let's call it, 34, okay, and change, like 34.70. And right now we're on the lower edge of the expected move. Okay, so that's of no surprise because if you looked at the SPX, okay, the SPX was, well, outside the lower edge of the expected move. So then where do I go? So I went over to the financials to find that they're at the lower edge of the expected move. Then I like to cruise over to the energy sector. Before I get to any big stuff, I go to the energy sector. Ironically, energy is at the upper edge of its expected move, right? It's pretty handy little tool here because it's actually, we're right in the expected move. So I then thought to myself, I'm like, well, what are the QQQs doing? Okay, what's Nasdaq doing? And the Nasdaq right now is completely unchanged. And in the Nasdaq, if you look at auto expected moves, well, it's actually still inside. And one of the things I really wanted to hammer home right now is, wait a second. So the SPX is outside of its expected move. The Nasdaq, okay, it's been a little weaker this week, but it's actually inside the expected move. The financials are down, kind of like the QQQ. The energy sector's up, and you start questioning, and what drove the SPX so far? Okay, like how is that even plausible? The answer is Apple. Apple is that big right now, okay, that it impeded upon the S&Ps, okay, even more so than did, okay, other tech stocks, which I'm about to show you here momentarily. And when I say even more so, well, obviously Apple, okay, is the behemoth on the block. It's the biggest market cap, all right, in the S&P. It's the biggest market cap specific to Nasdaq. But one of the most interesting things is Apple, okay, was even more influential this week to the S&Ps than it was to the Nasdaq. And I'm going to show you exactly the reasoning behind that. If you take a look at Apple, at one point this week, Apple was 4 standard deviations. It's going to close, it's not over yet, but it's going to close probably somewhere about 3 standard deviations, okay, below the weekly expected move. And the way to kind of handicap that, you go, oh, okay, the weekly expected move, let's say, is $3.50. So what's $3.50? Obviously times 2 is like a $7 move. Well, this had more than a $7 move. Okay, so it's closer to like a 3 deviation move, right? It's $3.50 times 3, yada, yada, yada. Stock moves down almost 10 bucks. There's your 3 deviation move. Okay, but what I wanted to show you that's so interesting is right now, nothing matters. Like the financials, they didn't really matter. Okay, energy, yeah, it didn't really matter. Now it's all about tech bifurcation. What's tech bifurcation? Again, we're going to look at Apple, which impeded upon the S&P significantly. I want you to look at Apple, then I want you to look at Microsoft. Okay, why? Yeah, Microsoft's towards the close to the upper edge of its expected move. You're like, oh, that's interesting. So if you look at tech right now, tech itself is wildly bifurcated, and tech, quite frankly, is the only thing that seems to matter. But I'm going to go a little bit further. If you look at Amazon, okay, Amazon's actually massively unchanged in the week. So we'll count that one out. Didn't have much of an impact. Okay, Google, massively unchanged in the week. Didn't have much of an impact. Here's where things get even more interesting. Okay, because we're looking again at the Magnificent Seven. Meta, almost unchanged in the week. Slightly higher, but almost unchanged in the week. When I say things are going to get interesting now, all right, Tesla. Okay, Tesla hit the upper edge of the expected move, pulled back off of it. But a very, very strong week overall inside of Tesla. NVIDIA, well outside, okay, of its lower edge of the expected move. One of the things that I just want to bring to the equation here that people are not looking at, okay, and giving enough, really evidence behind this to, is that tech itself, we're not seeing rotations from sector to sector. Like no one cares, right? Like retail, it doesn't matter. You could add up all the retail stocks combined. They don't equal Apple. We're now seeing rotations within a given sector. It's not a positive sign, in my opinion, for markets, okay? Because what you're getting is money management that is like looking for a home, and they realize, like, well, the only thing that matters, let's go to Tesla. Wait, no, today is Microsoft Day. Let's go into Microsoft. We're rotating within the exact same sector. Okay. And, some people call, like, the tech sector, well, now there's communications and there's tech. Look, okay, In the big seven over here, there's just tech, and that's it. And this is stuff that we're going to really watch carefully. Why? Because tech is bifurcated. It's when tech starts to correlate that we could run into some serious issues. Because the one thing, and the reason I wanted to bring this into the equation, you're like, so who cares? What? One tech stock is down, one tech stock is up. Okay. Yes, that's exactly why I'm bringing it to your attention. Had Apple actually gone down and Microsoft had cracked with it, you realize the damage that that would have inflicted to the S&Ps. Okay. The point of me taking you through this is not to tell you whether we're going higher or lower. Okay. The point is to display how damaging, okay, one stock can be. And it's only a 3 sigma move. And it did not pull other stuff with it. Okay. And the reason I bring that into the equation is this actually is more intimidating than anything I've seen in a long time, because you had, basically the second largest market cap out there bid this week. A lot. Like Microsoft hit the upper edge of the expected move today. Didn't matter. And that's the problem right now. It didn't matter. And the S&Ps are still closing to the lower edge or outside their expected move. You need to be mindful of this, okay, in the days to come. There's a ton of risk. And you're like, oh, whatever, man, it's over. Like Apple saw its sell side activity and that's over. Maybe you're right. But even more disconcerting, okay, what got the Nasdaq and the S&Ps to present valuation? What got them there? Well, look at NVIDIA, 217%. That's seeing some pretty ugly sell side activity. Not even going to sugarcoat it. Was it the energy sector that got us there? No. Okay. Was it the financials that got us there? Look, they're down on the year. Okay. So what else you got? You got tech and nothing but tech. You got, a little bit of Tesla, it's up 130%. Okay. A side order of Microsoft's up 40%. Apple now is only up 42%. But lo and behold, when it comes down to it, you can talk Meta to your blue in the face. That's up 140%. It's NVIDIA. Okay. And again, you really only had 2 tech stocks take a bit of a hit this week, and their hit was, it's measurable. Again, there's no question that statistical significance is around the Apple hit, right? And Apple 3 deviation move. I'm not gonna sugarcoat that one at all. You take a look at NVIDIA. Okay, NVIDIA is outside the lower edge of its expected move. Looks a lot like the SPX. But again, I think that this is going to be critical, because when you look at these tech stocks, one day you wake up and they're not, one green, one red. If they start to have higher degrees of correlation, we're in trouble. The S&Ps are in trouble. Okay, just keep it in mind. All right, moving on over here. I know I spent a long time on that, but it is critical that, tech is definitely, all right, under siege to some degree right now, but you're just not seeing it reflected because there isn't a larger degree of correlation, okay, within that particular subset. Triple witchings next week, all right, which is basically means what? Futures, they're going to expire, they're going to roll over. There's actually a roll going on inside of the futures right now. SPX is going through a primary expiration. Equity options are going to expire. The only thing to tell you on this front, because we now have higher interest rates, you got to look at the roll values. I'm actually going to freeze the screen for a second. I'm going to say the roll values. Okay, when you come in on Monday morning, we're no longer going to be trading SEP contract, meaning SEP, it's still going to be on the board, but it's no longer the active contract. The active contract is going to be the Z23, which is a DEIS. Okay, and the reason I'm bringing it up so that you can see this is there is a significant price difference between SEP and DEIS. How significant? 50 points. Okay, so there's going to be 50 points of differential. If you guys look at technical analysis, you look at MACDs, you look at Fibonacci's, you look at Bollinger Bands, make sure to come over to your futures chart, even if it's an intraday chart. Even if it's an intraday chart, come over to your futures chart. You got to make sure that your contract adjusted. Come over here to futures, adjust for contract changes, hit apply, hit OK. And what that will basically do, it'll put the 50-point adjustment in there. Okay, enough said on that front. I will cover more on live TheoTRADE on that next week. All right. Also coming next week, a lot of economic data, economic chaos. Look, we got CPI, we got PPI. There's like wholesale inventories coming in. I can go on and on. I think there's like a Empire State, number. The only thing I want you guys to know, and I'm serious about this, the only thing you got to know that economic data right now okay, is the only thing to look at this next week. The Fed is already in the quiet period. The quiet period officially starts for the Fed tomorrow, which is Saturday, right? So they go into a quiet period approximately, what is it, like a week before? A week before. So if the Fed meeting comes out on September 20th, they're in the quiet period starting tomorrow, which is September 9th. So Fed goes into the quiet period. This is going to make the economic data that's coming out all the more important. Remember, chocolate covered hand grenades. I don't care what the data is. It doesn't matter. Every piece of data is them just throwing, okay, a little grenade into a marketplace that can be wildly volatile. Just keep that in mind. One other thing I started looking at, and we may actually be selling some premium in small caps. Small caps are absolutely rocking. If you haven't been looking at this, start paying attention to it. It's been a long time since I've actually looked at Russell. The Russell, though, talk about volatility and breaches of expected move. It is, people, Mr. Toad's wild ride inside of the Russell as of late. And the volatility in here, okay, could be very, very opportunistic. I just wanted to give the Russell kind of a quick shout out over there because the rut is vicious. I mean, you look at some of the moves on, okay, the last few trading sessions over here, and this is where I kind of am questioning again. I'm like, it's just it doesn't really add up. I'm seeing moves in products, and I've always said this, and I'm going to say it again. Okay, when you don't have a great feel, and you start looking at the screen, and again, I've been around this business now, it's 25 plus years, and you look at the screen, and you're like, this just doesn't make sense. This doesn't make sense, or that doesn't make sense. The Russell doesn't make a lot of sense to me. Okay, couple that with like VIX, and the VIX is totally dead. And okay, I don't. Well, here I'll just cut to the chase over here. I don't like the look of the picture right now. Look at the dollar. Okay, like I don't know how else to shape this for you other than like people. Like, doesn't this indicate risk ahead? The dollar is straight up. Okay, I know you can. Well, there's a lot of reasons you can be actually piling into the dollar. I agree with you. There are a lot of reasons you can pile into the dollar. One of the biggest ones is I'm so scared that my own currency sucks. Okay, or I'm just rotating into the dollar because that's a great place to hide money. Because where else are you going to go? Okay, you're not going into the treasury markets, and that's actually what really freaks me out. Is look at the weakness inside of the treasuries, the weakness inside of the ZN. Okay, look at the TNX. The TNX. Now, far be it from me. I'm not a market technician, but that TNX sure does look like it's going to break out to the upside. And you got to open up like Max chart to just see how far we've come. You got to come all the way back to like 2007 to see markets like this thing could actually just rocket to the upside. But I'm bothered right now. Okay, strong dollar. Markets seem to be rotating into dollar. Higher interest rates are higher. Like nobody's buying the bonds right now. It doesn't leave me warm and fuzzy. Not at all. I look at it and say indicates risk ahead. And it's actually why I threw the Russell in there, because the Russell is seeing unruly volatility, right? You've got this big movement in dollar. You've got this huge movement into obviously inside of interest rates. Okay. Oil. And I was mentioning this on Wednesday night's video, and I'm going to mention it again. Oil is it's rocking to the upside. There's just nothing else to say. Oil's rocking to the upside, and a lot of crises have actually kicked off in markets because of incredibly strong oil. A lot of risk ahead for this marketplace, no question about that. And we would need to see a very fast and decisive change early next week to not look at this as being incredible risk. What I mean by that is I would have to see bonds rally back up very quickly, dollars sell off, oil cool off, to not see incredible risk. And the risk I'm talking about is if the S&P is staging a larger or more significant sell-off. And it's one of the reasons I was bringing up tech. If tech starts to correlate early next week, big trouble for markets. All right, moving on over here. Get your trade on this week's profits and losses. Look, shortened week. All I really did this week, I covered more ES calls. 50% gain if you're so inclined, kind of curious about that. When I say it's a 50% gain, okay, all I'm basically doing is just buying back short calls for over 50%, both in the ES and the MES. Last, but definitely not least, I always cover a little bit about expected move specific to the SPX. Now, I've talked a little bit about the SPX, and again, okay, we're not certain. We still got 15 minutes left inside of the trading session. But right now we're outside the lower edge of the expected move. And one of the comments I wanted to make right here, right now. And again, I want you to really grasp this, okay? I can see VIX is back down to the 13 and 14 handle. I can see that. I think we have a low volatility situation with incredibly high risk. You go, well, how can you say that? There's low volatility right now. As I said, look at the breaches and all the breaches you've seen inside of expected move. Now, these breaches, it does not mean that we have to breach next week. But what I don't like is we're coming off this 4-day trading week. We had $47 expected move. Consequently, we've moved a lot more than implied volatility gave us credit for. We started the week at, let's say, 45.15 inside of the S&Ps. We broke all the way down to basically 44, like 30 and change. I mean, for the most part, you saw what, just a tad under like 100-point move and kind of rallied back up a little bit. Things got a little bit crazy though, on what? Wednesday, some of Thursday's trades, some sell side in here. But again, the volatility just feels dead. And it makes sense that volatility is dead. This is well-charted territory. But what you got to be careful of is, and the reason I say it's low vol with high risk, like why does that even make sense? Next week, we're right now expecting about a $60 move. Clearly, that's higher than last week, but last week's a 4-day trading week. So next week, we're looking at the $60 move. But the way I look at it, I'm looking at the S&Ps, like $60. Well, holy crap, we were moving that much in one day this week. Like Wednesday, we had enough action on Wednesday, and that's the Big Apple news. That's like more than a $60 move. Okay, the SPX expected move again seems incredibly light. I'm not saying we're not going to close inside the expected move because that's the highest probability. But again, in the short duration, given the fact that there's CPI and PPI, and as I call it, chaos with economic data, you keep your hands and feet inside of the vehicle next week. All right. This is not a time to step out. And again, I'm going to reiterate, said this last weekend, and I'm going to say it again. You do not sell short duration premium. You're going to do anything in the short duration, you'd be a buyer. Okay, there's no upside in selling like a 12 vol. There's no upside in selling like 0 days to expiration, 0 DTE at a 7.58 vol. You're nuts if you do that. Okay, to further that, all you had to do was look here at the expected move. We cracked outside what the weekly expected move was anticipating. So with that, okay, I still see a huge amount of risk. Okay, we're getting great two-sided trade to this marketplace. We're not quite settled out yet, but as of right now, we are outside the expected move. As I said, I'm a little surprised. Highest probability, this marketplace wants to reach back right to that edge, see what actually comes about here in the next few minutes of trade. Thanks, everybody, for joining us here at TheoTRADE. Have a wonderful weekend. Bye-bye.